the high frequency indicators like car sales or e-way bills or two-wheeler sales or rail traffic, rail freight, toll collections, I think all of them are suggesting that growth is far stronger. And I'm not just talking about year on year, I'm talking about 3-year CAGR, so the annualized growth over the last 3 years, because we are now going back to the pre-COVID year and seeing. So the 3-year CAGR in real GDP is 2%. The September 2022 GDP was 6% higher than September 19. But the 3-year CAGR on a whole host of indicators is far stronger than that. The challenge, of course, then is how do you track the informal economy? Because the informal economy does not give out this data. So what we did was we looked at the energy demand, right? So dense forms of energy are mostly formal in nature. So coal, gas, oil, renewables, tidal, etc. These, if you combine together, the 3-year CAGR is 7%. And remember that GDP growth is always faster than energy demand, because every year you have some gains in energy efficiency, right? So cars use less fuel, ACs become more efficient, lights become more efficient, blast furnaces become more efficient. So if you add to that, the 3-year CAGR growth looks astonishingly high. Though I think there are some base effect problems. If you remember September 19, we also had a coal shortage problem. So there are some base, but even after you adjust for that, that 7% still becomes 4% plus CAGR. So we are talking about the indicators, if you look at BSE 500 revenues, the growth rate in 3-year CAGR is far higher than the nominal GDP growth that we saw. So on a whole range of indicators, we are seeing that the on-the-ground economic activities are actually stronger than what GDP data captures.
Great. In fact, before we go to portfolio call of yours, I want to understand that point of flows a little more, because a large part of the saving which you're talking about here in India as well got directed to the stock markets, some in the speculative nature, some more investment oriented SIP nature. What are your thoughts on flows from domestic pools, earning the kind of investing pools, and also add the element of foreign flows here? Do you see them coming back next year, or there's no clear evidence yet?
Remember that most of the foreign portfolio flows that come into India are coming through APAC funds or EM funds or global funds, right? So India dedicated funds, the share is actually lower than it was even 5 years back. So if more money goes into EM funds because people are feeling slightly better about China, then India also gets inflows. Now, my worry is that if the global interest rate environment remains tight, which is what the Fed's the dot plot showed last night, then this may not be sustainable. So there will be a wave of optimism that is now hitting us, which is that China opens up. Every other day you are hearing newer and newer relaxations. Now foreign travelers are starting to travel to China much more freely. In specific pockets, I think restrictions are being eased. So all of that, as it happens, I think the expectations will push up. But my fear is that what we are seeing as positive development, we wrote about this just today, that what we are seeing as positive developments in terms of inflation in the US coming down, which is mostly goods prices coming off, that's bad for the exporters, right? So the export prices from Asia and a lot of our region is badly affected when goods prices start coming down. So our fear is that the next 6-9 months is going to be quite turbulent from the foreign flows perspective. In domestic flows, I think the institutional flows like from EPFO, from insurance, and to some extent from SIPs together are $30 to $40 billion a year. Those flows, there is a certain predictability to it. Short of shocks, I don't see that changing. The discretionary flows, the non-SIP retail flows, where people choose between other asset classes and equities, I think the likelihood is that those flows will moderate, perhaps may even go negative, because if your equity risk premium is negative, means that sovereign bonds are more attractive than equities right now. There is a clear revival in the real estate market, so people are going to be investing in real estate as well. There is revival in investment demand in real estate as well. But net, I think the domestic flows should be able to offset some of the pressures from foreign flows. The one concern that I have, and it is reflected in our model portfolio as well, is the risk of an accident, which is that in the global financial system, what if some real estate market in a reasonably large economy suddenly sees undue pressure because effective rates are still rising, and when that happens, there could be a sharp slowdown in dollar availability for India. For any economy which runs a current account deficit, that is going to be a period of extreme volatility. So that's something that we need to be cautious about. But on the whole, demand for equities from investors, either domestic or foreign, should remain quite steady.
Right. Neelkanth, one of the big factors for India's outperformance, both on growth front as well as on market returns, superior returns versus the world for the last few years, time periods actually, is being also attributed to very decisive policy making and execution on the reform front. How do you rate that? Because you must be interacting with a lot of investors domestically and globally who are looking at India now. And are these things also coming up in discussions, that decisive policy making and thrust on reforms is also one big factor for market returns and investing environment?
Absolutely, but more than the specific reforms, I think the general comfort with the macroeconomic management is something that is of course visible in conversations, but also visible in actions, right? So the fact that despite all the concerns around and all the pressures around the lockdowns and the damage it did to especially the vulnerable, the fact that the government was very focused, did not waste its fiscal resources, managed to sustain through grains transfer, which was reasonably clean, and as a result of that, once we go into a period of volatility in global markets, India comes across as a place where inflation is not out of control, is starting to come down. The fiscal situation is under control, and the lagged effect of a lot of the tough reforms that happened in the 2015, 16, 17 period are now showing up in greater tax collections, right? So even the corporate tax cut, which just preceded the COVID problems, now corporate tax to GDP as a percentage, if you look at last 12 months collections and last 12 months of GDP, nominal both, we are back to 2008 levels, which was the peak. So all of this is providing, even if people don't state it, it's actually part of the investing process, that this economy looks really steady, and of course, people then project from this that going forward as well, you will see progressive action. In fact, the prospects of the China plus one now, in terms of the potential for exports that this gives India, is something that also repeatedly comes up. And there, I must say that it's not just the central government, but some of the state governments taking the lead and starting to solicit business and investments from large multinationals, is something that is also showing up in a lot of investor conversation.
Sure. Let's talk about portfolio construction then. Financials is something you have a big overweight on, but how would you look at the different parts? PSUs are very excited, kind of a re-rating moment, or the private ones where numbers are improving a whole lot. How do you see this part?
So, on PSU banks, we have been overweight for a while now, but we remain very selective. So, in fact, my colleague recently reiterated and in fact, he upgraded some of the banks as well. But we would prefer to be selective, right? So we would prefer to be in PSU banks that have at least double-digit ROE, where because if your return on assets, return on equity is actually below what is your cost of capital, then the if you grow too fast, then you have to come back to the market and raise equity, right? So the likelihood of some of the better quality PSU banks, and we are very overweight, and we are strongly recommending them. The stocks have done well, but we think that there is further re-rating potential. We continue to like the PSU, the private banks, but our preference has been PSU over private for a while now. And we think that over the next 6 to 12 months, that preference will continue to run. These are also generally underheld, but we are not going down the quality curve, right? So even among PSU banks, we are not going whole hog. Some of those stocks can do well in the near term because they are underheld, because they are cheap, and there is a clear valuation arbitrage. But we worry that the shocks around potential problems or the need to raise capital urgently, all of those issues can come up. So we would still be focused on a select few PSU banks. The construction bit that you brought up, I think there is going to be strong momentum on infrastructure construction, not just at the central level, but at the state level. As I mentioned earlier, there is clear evidence that states are now starting to get their spending in order. And I'm not just talking about the lived experience of what's happening in Mumbai, where there is a clear pickup in the pace of construction on a lot of the infrastructure things that we see around us, but also at the national level, in many other states, you are starting to see spending and plans becoming more concrete. But the biggest chunk in construction, in my view, is going to be housing construction. We have been through nearly a decade-long down cycle. We wrote about this in November last year as how we expect a multi-year revival in dwelling construction. And I'm quite encouraged to find that is starting to play out, that is playing out. And we think that this never is a 12-month cycle. It's always a 3-5 year at least cycle. I'm a bit apprehensive about the house prices going up a bit too fast. I would rather play it through the volume. From a prescription angle, it would be better to have volume growth than price growth, because volumes add to GDP, prices don't. But to some extent, better prices are also a catalyst for developers to accelerate the pace of construction. So all in all, I think construction as an activity on infrastructure as well as dwelling construction is likely to do well in the next 12 months.